Siamo alla fine con l'ultimo intervento, ringraziamo Tom Leahy per la pazienza, ci darà lo sguardo di un operatore internazionale sul mercato corporate italiano. We take a look at the corporate market. Please, Tom Leahy for 15 minutes. Thank you.
Thank you, everyone. I'm going to... hello. I can see myself twice now on my screen, which is very confusing. Good morning, everyone. My name is Tom Leahy. Oh, sorry, I should say good afternoon. I work for Real Capital Analytics in London as a senior director on our analytics team. And we work with Nomisma, and they provide us with data on the Italian real estate market. And they've asked me today to talk you through some of the trends we are seeing in the Italian real estate investment market, but with a European context as well. So I'm going to proceed and move through the presentation. I think I'll only be speaking for around 15 minutes. I believe I'm the last one of the day as well, so not too long till the end. Okay, so what can I say about real estate in Europe so far? And really, we're talking about obviously the big changes come since the start of the COVID-19 pandemic. And this chart looks at real estate investment volumes. Can I just, sorry, I'm afraid there's someone speaking in my ear. If they can mute themselves, that would be great, because otherwise I can hear you while I'm trying to present. Thank you. Okay, so all property transactions, where are we across Europe at the moment? So you can see, hopefully on the chart, this shows real estate investment volumes across Europe, split by the different quarters, split quarter by quarter. And you can see, hopefully, there are two particularly low quarters there in the middle of 2020. So the second and third quarters of last year was slow, and that was because of the impact of the pandemic. The market in Europe did not slow as much as it did in the United States, where volumes slowed very, very markedly by 70 or 80% in some cases. But nevertheless, the market did slow, and you can see on that bottom chart there the 4 quarters where volumes were down year over year. So that's where the total invested was less than the equivalent period 1 year earlier. But we have now recorded 2 quarters of growing investment volumes. So where the volumes were up versus the middle of 2020, which were the slowest periods for the market, but that's not surprising. But nevertheless, if you look at the last couple of quarters where more than 70 billion has been invested in European real estate, that's above the recent average. So that suggests that the market has certainly regained some of the momentum lost due to the pandemic. And obviously, the progress of the vaccine rollout has helped. The loosening of travel restrictions has also helped. I think there are some worries about what inflation might do for real estate. In some respects it can be good, some bad, but I think broadly, investors are still allocating capital to the sector, and we're seeing that come through in these investment volumes. But one of the things that I think the pandemic has done is it's accelerated the changing fortunes if we look at the market split by sectors. And I know this is quite a busy chart, but actually the message is quite simple. The sectors in the top right-hand quadrant are where volumes are up, not just against their equivalent period last year, but also against a pre-coronavirus average. So R&D, so that's life science properties, that's very much in demand from investors. Logistics is the one that's on everyone's lips at the moment, and logistics property across Europe, logistics volumes across Europe are close to record levels in a number of markets. But also residential assets, so that's apartments for rent. And I know that's not a particularly large asset class at all in Italy. Italy is probably the largest market in Europe where residential volumes are still relatively low if you compare to Spain or Germany or France or the Netherlands or the UK or Sweden. There is a growing residential investment market, but I don't think you can yet say that is the case in Italy because of, I think, historical reasons and the way the market is structured. So life sciences, logistics property, taking advantage of this moves to online retailing and efficient and shifts in supply chains, and residential property taking advantage of shifting patterns in where people are living and how long and how they are living. And on the other side of that, there are the sectors that are less in demand, and those are those in the bottom left-hand quadrant of the screen: shopping centres, other retail properties, office properties. And those are clearly the parts of the market where investors are viewing the risk to be greater. Certainly for retail shops and shopping centres, that shift has been going on for a while. But in offices, it's relatively new. Offices have long been the largest asset class in Europe. But there are worries about the extent to which occupiers will change and shift and downsize their portfolios as some, not all companies, but from what I can gather, the majority of especially professional services companies shift to a hybrid working pattern with part office and part home. You know, I'm at home today in West London, and so that's clearly having an impact on demand for offices. Not all office properties, but as an aggregate, investment is down, but there are some interesting trends, and I will speak about that in a second. So that's across Europe. What can we say about Italy? Well, the trend in Italy follows the European-wide one to an extent, and that is industrial property is the largest asset class this year if we're just looking at total invested. And that's for the first time ever. Now, admittedly, we're just looking at, or the first time ever this, you know, through this cycle for a while. And so, you know, that's clearly a change. You know, previously it either been offices or perhaps retail properties that were the number one asset class, but the demand for industrial is such that it's accelerated ahead of those two sectors. And hopefully you can see that clearly on the chart there on the right-hand bar of the screen. And as I was saying, you know, apartment properties, which are in the orange block there, relatively small volumes, and that's a shift in comparison with some other European markets. So industrial number one this year, and that's on the back of the very strong demand, both from domestic and international players for logistics units let to the likes of Amazon. And this is having an impact on how the market is structured. So if we look at the investment volume split by the different sectors, and I've got 5 European markets here. I've separated Italy out just here on the right-hand side of the screen to make it easier for you to see. If you compare with 2015, across all these markets, you know, apartment and industrial, or as we colloquially call them, beds and sheds. I think we like it in English because it rhymes. We're fairly simple-minded like that. Beds and sheds in the UK was less than 20% of the market. It's now more than 40%. In Germany, it's as a proportion of the market is growing. The same in France. Netherlands, it's come down a little bit from last year, and that's partly because of some new regulation in the residential market there. But Italy is the same story, but it's really driven by the growth in demand for industrial property. As I've said, you know, residential makes up around 5% of the total, whereas in the UK it's around 15%. Germany it's 30%. France has grown to around 20%. But nevertheless, the same pattern is there, and it's a shift in the market structure with office and retail being squeezed, and industrial and residential assets becoming more in favor. And there we go. I've got Italy highlighted there for you. So what does that do to pricing? So this is a price index we produced using transaction data, and it's just looking at Italian logistics properties. And you can see clearly actually that the trend started a couple of years ago in terms of the uplift in transaction prices. And that's because this move that's been accelerated by COVID was already underway. And more recently, you can see there was a little dip. During the pandemic, linked to some of the uncertainty, but the market has regained any ground lost, and prices are now as high as they've ever been for Italian logistics properties. And that fits in with what we're seeing in plenty of other markets across Europe, where record prices are being demanded for logistics units. So where are these deals taking place? This is just a heat map of the deals that we've got in our database for the last, well, almost 3 years. So from 2019 through to September of this year. And it's very clear that the focus is on the urban areas in the north of Italy. So along the kind of the A4 corridor between Turin or Torino and Brescia. So you've got Milan and Bergamo as main hubs, and then obviously Rome as well as an urban logistics hub. But very clearly, the units are trading across that northern corridor really, and that's where we're seeing strongest demand for properties from occupiers and then from investors. And just a recent example of an asset that has traded very recently is a building let to Amazon. And it's on that along that A4 corridor. And it's been bought by a consortium of South Korean investors. And interestingly, the South Korean investors have previously been very active in Europe, but the volume slowed because of coronavirus and the travel restrictions. But it's interesting to note that they've come back and they've acquired this asset. They've been acquiring quite a lot of Amazon-let units, not just in Italy, but in Spain and in Northern Europe too. And an Amazon-let warehouse is perhaps the most in-demand asset globally, perhaps at the moment. And so this is just looking at the change in prices for a warehouse let to Amazon versus a series of other property assets. And also I've got the MSCI World Index on there. So that's an equities index. It's using our RCA hedonic methodology. And the story is very simple. Amazon warehouses have increased in price by 80% in the last 5 years, and that outstrips almost every other property asset class globally. Interestingly, it outstrips, the standard US or UK logistics sector. So even though prices in those sectors have gone up, if you've got an Amazon tenant in your building, it really accelerates the price growth and the demand from investors. Talking about investment into Italy from overseas, and that investment from those South Korean players is one example of that. And Italy has typically been a market that is relatively dependent on overseas investment. So this just looks at the top 15 markets in Europe and how much was invested, what the split of the market was in the 3 years to the end of 2019, so excluding the COVID period, because things have obviously shifted somewhat. And you can see the market hopefully is relatively evenly split between domestic sources of capital, what we call at RCA continental, so that's other European investors, and then global, so that's non-European sources of capital. So around 2/3 overseas, 1/3 domestic, and that puts Italy as one of the markets that's more dependent on overseas sources of capital. You can see it's a similar picture in Spain, in Ireland or Poland, where Poland's even more dependent. Just over 10% of all capital invested in Poland is domestic. In Italy, it's more like as you can see there, 30%. And the other comparison with some of the other larger European markets, let's say like France, or Germany, where it's closer to 60% domestic and 30 to 40% overseas. So that obviously presents certain challenges for a market, especially at times of dislocation, and when the crisis that we've gone through was unique in the way that it restricted travel. And what we saw in our data was that during the COVID period, so the 12 months to the end of the first quarter of this year, which was the most sort of acute period in terms of the spread of the virus and the travel restrictions, the markets that were most dependent on overseas capital saw bigger falls in volume. So these are the markets I've ringed down here in the bottom right-hand side of the chart. So the likes of Poland, Portugal, Czech Republic, Finland, Spain, and Italy saw greater on average falls in volume versus some of the markets that were less dependent on overseas investment. And Switzerland is the obvious example there. Highly domestic, and actually volumes were up during the COVID period. Now, there's obviously a range here, so I think Italy did fare better than some of these other markets, but I think as a general rule, it holds true. So who's been investing cross-border since the start of COVID? I thought it would be interesting to see actually, okay, who's been buying? So since the start of January, what investors have been active in the market? So you've got Apollo Global, and this is just overseas investors, I should say. So I haven't included any Italian investors on here, but it's a mix of US and some Asian and other European sources of capital. But interestingly, and this is how much they've invested in the last, what would it be, 21 months. So to the end of September of this year. But I thought it'd be interesting to also look at what they've, were these investors active in the market pre-COVID? And interestingly, some of them hadn't been for a while. So Apollo at the top there acquired a large portfolio of Italian assets, and that was their first purchase in the market since 2014. GLP, the Chinese-based logistics investor, they made their first acquisition ever in Italy earlier this year. And the same for Iconic Capital, who are a San Francisco-based buyer of largely of data center assets. And similarly, someone like a buyer like BNP Paribas, they've been relatively active in the Italian market, investing just over $1 billion in the 5 years to 2019, but actually they've already invested. Not the investment volumes in the last 21 months aren't far off that. Same for Allianz, they've bought more in the last year, well, year and 3 quarters than they did in the previous 5 years. So that suggests that appetite is there from this group of investors to keep acquiring Italian assets where they can obviously get their hands on them. And notably, I just finishing off here, so I've only got a couple more slides. Been relatively active in the office market as well. And obviously there's been a lot of conversations about the office market and how the fortunes are changing in comparison with the pre-pandemic because of the shifts in working patterns. And so you can see this is just looking at office transactions in Italy, and I've split between Milan and Rome and then the rest of the market. So volumes are down this year in comparison with the average, but that's not surprising, and it's the same across the whole of Europe. If you look at office investment volumes in comparison with the pre-COVID average, they are down. But nevertheless, there are some interesting stories within that. And so overall volumes are down, but actually demand seems to be relatively strong for the better quality assets, those that are centrally located, with good quality tenants. And that's pushing up prices for those assets. So even though volumes are down, prices are going up because there's strong bidding for the better quality buildings. And you can see this dynamic here just in this pricing chart I've got. And this is my last chart before I hand back to the organizers. And you can see quite clearly, hopefully, that prices, although they did dip in Milan, according to our pricing model, and this is based on assets that have traded, so it's not a valuation-based index, it's a transaction-based price index, that prices in Milan are at a record high. So they did dip a little bit during the pandemic, but they've climbed back up again. And that's, as I said, is on the back of strong demand for good quality buildings. So a good example of that would be the Liebskin building that's just sold in Milan, or 50% of it was acquired by a domestic insurance fund, and that's an iconic building. It's designed by a very famous architect. It's occupied by PwC. It's new, so it fits in with all the criteria. It's got a gold LEED rating, so it's environmentally friendly. So that fits in with the kind of criteria that investors are looking for when they are buying offices. So offices are trading, but more selectively, and for the buildings that are trading, especially the better quality buildings, prices actually are still going up. So that's it from me. I will say thank you very much, and I will hand back to the organisers.